For the second straight Tuesday, we had quite the sell-off in the stock market, with the S&P 500 down over 1% today. We did have a kind of cooling off JOLTS number here and some other economic reports that suggest maybe the economy is not quite as hot as it once was. But there was an ongoing banking crisis that was kind of front and center with the market's interests here today. Many regional banks were down between 5 and 10% today. We also saw oil stocks get hammered here today, with oil prices slashing directly through that 30-day moving average. We'll also talk a little bit about some macro conditions, including what's been going on with gold, also what's been going on with preferred stocks in tonight's video. And then we'll also get into a trade application example where somebody who I admire quite a bit might say something like, "Buy when there's blood in the streets. Be greedy when others are fearful." All right, having a little bit of fun since it's Berkshire week, but just like Buffett would do, try to take advantage of chaos within the markets and maybe do something bullish on a day when a lot of others are quite fearful out there, and will be selling a put on a dividend growth stock that has not only a weekly oversold cluster signal, but also a monthly oversold cluster signal. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 2nd, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list. Quick heads up on that. I mentioned this last week as well, but once again here, I'll be gone this Thursday, so there will be no video this Thursday, as I'll be back in Omaha for the big Berkshire Hathaway event. As I go back there pretty much every year since 2005, except the 2 years they did not allow a live audience as a result of COVID. But many of you like to follow my journey during that time period as well. So if you're interested in some of the things that I pick up along the way, I would also encourage you to follow me on Twitter. My handle is @BrandonVanZee, and I'm sure I'll be tweeting quite a bit about Warren Buffett and Berkshire Hathaway and Charlie Munger and all that kind of good stuff here in the coming days. In addition to that, we are also on Facebook. If you're not doing so already, I would encourage you to join our group you see in the web address and the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 pulled up here in front of us with their heat map, and my oh my, another difficult day in the market. Remember, it was last Tuesday that I was with you, where we also had a pretty ugly day. For whatever reason, it felt worse to me today than a week ago, despite last week having a more aggressive sell-off. And I think it was because it included a lot more of the sectors this time around. Last week, I think the consumer staples held up a little bit better, and maybe some of the other defensive areas. But here you can see it was pretty much across the board. You didn't really get much in the way of green rectangles and squares that were out there. You had a little bit there out of Big Pharma with Johnson & Johnson and their widely expected spinoff of Kenvue coming up here very quickly. They were up here today by 0.87%. Merck managed to close higher by just over 1% today. Some of the drug distribution companies like McKesson and AmerisourceBergen and even Cardinal Health, those three were all up here today. We did have Abbott Labs also up a touch. Zimmer Biomet, which is actually a company that we focused on in our top-down trend trading class here a couple weeks back, is up nicely here today, another 3%. We also had a handful of travel-related names that did well today, including Marriott, up about 5%. I believe that was off of one of their earnings announcements there, but looks like Booking was doing pretty well, up 0.93%. That's another stock that we've looked at in my top-down trend trading class on Mondays here not too long back, because those travel stocks, they've been working for a while. You can also see that O'Reilly and AutoZone, some of the auto parts retailers out there, managed to close in the green. Had a smattering of industrials companies, Eaton and Amtech and Train, JCI, even John Deere managed to close the day higher. And then it was relatively bleak, even for the defensive areas, where normally you would find them to kind of be a bastion of safety on a day like this, but really even in the consumer staples, they got hit pretty hard today. The Mondelez did manage to close higher. Remember, that's the company behind the Oreo cookie. They were up about 0.5%. Kellogg managed to close up about the same amount, a 0.5%. Conagra and Smucker's also there, kind of in that 0.5% to 1% range there. Clorox also was up just barely here today. They reported earnings after hours here tonight. They were trading a little bit higher after that as they came out and beat analyst expectations on both earnings and revenues. So we'll see if they open up higher tomorrow or not, but so far so good with that announcement out of that aristocrat after hours here tonight. And then the best performing stock in the entire S&P 500 today was this really small green square you see all the way off to the right hand side here, and that is Molson Coors. So raise a beverage to those of you that like the Silver Bullet, the Coors Light, and their associated drinks. They have a number of brands under their portfolio umbrella, but they reported earnings today, and the market must have liked what they saw because that stock was up nearly 8% on this very difficult day for most other companies that were out there. Should also mention that gold mining stocks hung in there all right today. There's Newmont Mining up about 2.4%. So you can see it was pretty bleak out there. Really, those are one-off types of situations more times than not. It really didn't have a consistent pattern in terms of who managed to avoid the pain here today. A lot of it was just, hey, did you happen to report earnings today and did they come in okay? For the most part, if that did not describe your story, then you probably finished the day in the red, and some of them violently so. Today was another one of those days where it reminded us that we're not done with this banking crisis yet. As much as people want to tell you that, the proof is in the pudding. And if we were done with it, they would not be reacting the way that they are. And so you can see up here, a number of these banks got crushed today. Even JP Morgan, the one that was supposedly at the advantage of the First Republic takeover here over the weekend, they were down 1.6% today. Now, they still held in there a lot better than most of the smaller ones, but just trying to make the point that even the ones that are perceived to be the highest quality banks out there got hit today. In addition to Bank of America down 3%, there's Wells Fargo down nearly 4%. Citigroup down 2.5%, and then some of these regionals really got clobbered. There's US Bank down 7% today. There's KeyCorp down 9% today. Fifth Third down 5%. Huntington down 6%. Regions down 6%. M&T down 3.5%. Truist down 7.5%. Zions, that was one that's out here in my neck of the woods, down over 10% today. And then there's First Republic, but technically it's not really trading anymore, so I don't know why they still have that on this heat map. As I've been sharing with you guys over the last several weeks, this heat map needs a redo. So if any of you have connections over at Thinkorswim, maybe plant that seed in the back of their mind or in their ear or what have you, because we still don't have the update in terms of seeing like Visa and MasterCard are nowhere to be found on here because of that sector transition that I was telling you guys about a couple of weeks ago, in addition to a number of others like Pepsi and Coke are missing. And some of you have been following the Pepsi saga with me on Twitter after hours, as Seeking Alpha made a snafu of their own, reporting that Pepsi had cut their dividend. And of course, they would be one of the last companies to do that. And so it was just an error in their reporting there. But nonetheless, you don't see Pepsi or Coke showing up here on the heat map. So this is a Thinkorswim issue. There's nothing I can do about it, unfortunately. But until they get their ducks in a row in terms of this sector and industry transition, we just have to kind of put up with it. So it is what it is. But the point being, the financials got cooked once again here today. Another area that was tremendously out of favor was the oil companies. Look at all this red up here in the upper right. Even ExxonMobil, which had just hit an all-time high, I want to say it was either yesterday or on Friday, they were at all-time highs. It was kind of a remarkable occurrence considering they were a $30 stock just a few years ago, but here clearly well over $100 these days as oil prices have recovered Today was not their day. They were down about 4%. Chevron, same thing, down 4%. Both of those companies, for those of you that follow my dividend growth investing process of using the high yield theory, will know that those two have done really well in price in recent years, where their dividend yields are no longer considered attractive for new money. In fact, it's the opposite. They're up in the orange zone of the stair-step charts, or at least close to it. And so this would be a time where those overvalued shares could be either reduced if you're into that sort of thing, or selling cover calls on them, or different things like that is a possibility. Obviously, it's a little trickier said than done, because you've got to remind yourself that oil prices basically can push those oil companies around on a whim on any given day. But for those of you that have enjoyed your experience riding Chevron and Exxon higher in the last couple of years, milking them for their dividends that were once nice and juicy at 5, 6, 7% type of a thing, you don't quite get those masterful yields these days, and now it may be time to give some of that back. We shall see. But today was not a good day for the oil companies, and that includes some of the smaller players out there as well. EOG, and there's Phillips 66 finally locked that one down in our dividend class here today after waiting quite a long time. We had set a buy limit order at $95, and for a few weeks it looked like it was going to run away from us without getting filled. So we were thankful today that it finally pulled back and we got allocated there in the energy space, because it's hard finding oil companies that have attractive enough dividend yields and valuations here today, because most of them have run up so much in recent years that they no longer fit our valuation rules anymore. But Phillips 66 was a rare example of one that we could justify putting into a 25 stock portfolio. So that was the news of the day there. You can see that tech was down today as well. It wasn't down nearly as aggressively as financials or energy, but still a pretty difficult day. Apple, of course, has a lot of people looking at it here this week, as they will be reporting earnings, I believe, on Thursday, I think, if my memory serves me correctly. So that's going to be the big kahuna this week. Remember, last week we heard from most of the other mega cap tech-oriented companies, but this is Apple's week to shine, or perhaps the opposite of that, depending upon if they drop the ball on their earnings or not. And of course, we have Jerome Powell and company before that. Jerome Powell will come out tomorrow with the interest rate decision, and it is widely expected to be a 25 basis point hike to continually offset the inflation that we're all dealing with here. But with today's crisis kind of developing before our eyes, especially in the regional banks, there were some whispers out there that maybe, just maybe, they would come out and decide not to raise interest rates at all. I personally have a hard time believing that, but I can understand the story as to why others might float that idea. So we shall see, and we'll find out here soon enough. Tomorrow at 2 p.m. Eastern Time is when we will expect to hear from Jerome Powell about interest rates, not only what they're officially doing this time around, but kind of judge their temperature and sentiment as to what is their thoughts about the future, and whether this will be the final rate increase, or whether they're going to keep on stepping on the necks of the market, so to speak, trying to get them to understand that they will do whatever it takes to defeat inflation, right? That's a message that they want to send out there, that they're not just going to roll over just because the market's getting hurt a little bit, because of higher rates. Their job is to kill inflation. And so I wouldn't be surprised if we hear more tough talk out of Jerome Powell and company tomorrow. All right, let's go ahead and take a look at the official breadth numbers now. And I'll pop one over here to the paper money account. And you can see that on Thinkorswim, it does show, on this part, they do show all 500 companies. So in case some of you were wondering, well, does that thing that I was talking about with Visa and MasterCard and Pepsi and Coke, does that affect these official numbers over here on the other part of the platform? The good news is it does not, because this does not necessarily distinguish them by sectors and industries. That's what's really messing up the heat map right now. This is actually showing us the 500 companies in the S&P 500, and just 93 of them closed higher here today. And so that was only about 18% of the market basically closing in the green. And so another way to judge that today was obviously a day for the bears. It was not just a fluke that the market was down because of a handful of mega cap stocks. It was widespread selling across nearly all of the sectors here today. Let's go ahead and pop on over to the charts now. And as you are aware, as long as you've been watching this video for any amount of time over the last several years to a decade since David and I have been doing it, not just here at Market Scholars, but of course previously when we were at the education company at TD Ameritrade, we had a very similar video. So those of you that know my routine by now will know that whenever we have a 1% up move or a 1% down move, I like to bring this chart up here because it helps us gauge what's going on with the VIX. It also helps us see visually a slightly different way to understand that volatility. And so first things first, just be aware that the S&P 500 was down 1.16% today. You can see there's a little bit of a lower shadow on today's candle. It was not what I would identify as a long lower shadow, but there is one that is visual there. So a reminder what that would mean is we did not close at the lows of the session today. We might have had a little bit of push into the close, that the bulls were able to kind of scoop up some value here and there. And of course, many of you know that whenever we have a 1% sell-off day in the market, and it happens to be a Tuesday or a Thursday, when I am scheduled to do these videos, that you are going to expect that I will show you a sold put opportunity at the end of the presentation, which once again is the case today. Those of you that are premium members of Market Scholars already know what that is because we send out the screenshots and the execution prices and all that kind of stuff via our private Telegram channel that we have for our premium members, and those trades are actually done during the trading session. So when we got a little bit of a bounce into the market close today, that actually benefited the bullish trade that I put on. So we're up a few bucks on that already. Not a big deal, but just a reminder that that is a key benefit for those of you that are considering becoming premium members of Market Scholars. David and I teach a number of trading rooms at Market Scholars, 8 of them in total, which each one of them has their own portfolios and management rules and entries and all that kind of stuff. So we're taking all kinds of trades and investments regularly, not just these free videos that we do here on YouTube. So all of those trades are deployed out to our premium members via our Telegram channel. So make sure you're taking advantage of that. But anyway, you can see that we do have a lower shadow right here telling us that we did end up closing a little bit off the lows of the session here today. You will notice down at the bottom we have this purple line that will show us the pathway of the VIX, of course what some would refer to as the fear index, in order to track the S&P 500 and the willingness of especially professionals to be buying puts and hedges for their portfolios. That is kind of being judged through the VIX itself. And the VIX, as you can see, did rise here today. It is still at what I would consider to be a relatively low number, but it is back up to 19 approximately. You can kind of see that in that purple label off to the right hand side, or you can read it in the label above the chart down there as well. And a reminder, these premium these customized charts here are available to our premium members as well. So many of you will follow along with David and I. This chart happens to be 6D if you're a premium member and you've already imported them into your own Thinkorswim platform. Anyway, the real reason I like to look at this on a day like today is to kind of judge visually here in the middle what type of volatility we've had lately. Sometimes volatility is to the upside. Sometimes volatility is to the downside. Sometimes we don't really have much in the way of volatility, right? A week ago, we were talking about how finally, we had a 1% down day, and I think it was 23 days in a row where we didn't have a single 1% down day, and we finally got one here last Tuesday when I was with you. And here we can kind of visually see what today's activity looked like in comparison to last Tuesday or any other day for that matter. And this can help us visually confirm what I had mentioned in passing here earlier in the video when I said I believe last Tuesday was actually a worse day for the market, but today felt worse for me. And part of the reason behind that is, of course, I have a lot of consumer staples, as I've shared with you in the past, not because I've bought them recently because they've been going up, but because I'm a dividend growth investor who bought many of those consumer staples many years ago and have been benefited by that here more recently. So today, with the consumer staples apparently getting hit nearly as bad as the other sectors that are out there, which is a little bit odd because remember, typically consumer staples are not going to go down dramatically on days when the market gets hit. They're going to retain their value a little bit more. That's the good news. The bad news is they oftentimes don't go up as aggressively as like tech stocks or different things like that either. So you kind of have to take the good with the bad with that. But anyway, for me, in my own personal portfolios today, I felt like today was just as an ugly of a day as it was last Tuesday. But if you look at the actual evidence, that is not the case. Last Tuesday was a worse day for the stock market. It was a day probably when mega cap tech was getting hit a lot worse than today. Remember when we were looking at the heat map here a moment ago, Apple and Microsoft and some of those actually hung in there okay. They weren't down like 3, 4, 5%, that type of stuff, right? We were seeing that in the banks and the oil companies today, but we didn't see it out of big tech. And since big tech is really what controls the price activity out of the S&P 500, since it's a market cap weighted index, then I think that kind of altered my thinking here today as far as what my perception was in real time, what was happening, because I don't have a lot of big tech. I have a little bit of it, but my portfolios as a dividend investor are driven much more by, let's say, consumer staples or healthcare or what have you. So to me, it felt like today was worse, but those of you that have a lot more big tech like Nvidia and Apple and Microsoft and Alphabet and Meta and those types of companies, you actually fared a little bit better today than what you did a week ago when we had that pullback. So I found that to be somewhat interesting there as well. So a big volatile day here. We've now had 2 1% drops here in the last couple of months, adding to that tally. Still a pretty quiet period compared to the way that we saw all these red bars over here reaching down into the blue and the orange zones regularly, right? We haven't had a 2% down day since I think it was this day right here, and that would have been back on February 21st. So it's been, nearly 3 months since we've had a 2% down day. But we had a lot of those last year. It's been pretty quiet so far here more recently, where most of the big days that we've had have been days to the upside with these green bars up at the top, not the red bars down below. Things can change in a hurry, of course, and it could very well be spurred on by whatever happens tomorrow, right? The Fed still has a lot of control over the market and can be acted upon as a bit of a catalyst in either direction. So we'll learn a little bit more tomorrow, especially in the press conference. Remember, be careful not to get whipsawed tomorrow. That will happen quite regularly on FOMC days, where the market will take off in one direction upon the original announcement of the interest rate decision, and then an hour later, when Jerome Powell is in the press conference, the market will completely zig and zag the opposite direction once he kind of clarifies his thoughts about the future. So careful not to get chopped up tomorrow either. All right, let's go ahead and take a look here at our normal 4 grid now. This will be chart 4B for those of you following us along at home. And this will show us the 4 major U.S. equity indices. And after today's selling, somewhat surprisingly, we just have one index that is in that bearish pink background color there, at least if you're using the intermediate posture as your guide. So we do have a strongly bearish posture on the Russell 2000, but the other 3 charts are still bullish despite today's aggressive selling. So the Russell 2000 was down 2.1% today. It was the worst performer today. Remember, it has been the worst performer. So it's not like it somehow zigged while the market was zagging today. Basically, it's been underperforming this entire time and underperformed even more here today. So whether the market's up or down, if you kind of use the S&P 500 as the so-called market, the Russell 2000 has been underperforming it in both directions. And so it's been a tough slug there. And in particular, it's kind of interesting to compare the Russell 2000 to the NASDAQ. In fact, I was just kind of tweeting back and forth with David about this very thing as well, because he was mentioning how there was a tremendous lack of correlation right now between the NASDAQ 100 in his case, what he was tweeting about. This is the NASDAQ composite, which is a little bit different, and the Russell 2000. And one thing I had mentioned, and many of you are aware of as well, I'm sure he knows about this as well, but one of the reasons why there is no correlation right now between the Qs and the Russell 2000 is because the Qs, by their very definition, are supposed to be the 100 biggest non-financial companies in the NASDAQ composite. Now, I don't know with this this whole sector rotation thing that took place here recently, if that's 100% true right now. And what I'm thinking about is stocks like MasterCard, Visa, and PayPal. Those companies could have very well been among the 100 largest companies in the NASDAQ composite, and they were once known as tech stocks, but they have since transitioned officially to become financials. I just don't know if the Qs have updated their portfolio at this point or not. Probably have, but I just haven't looked at it for sure. But the point is, that's the way that the Qs are set up. The QQQ is set up as the 100 largest non-financial companies in the NASDAQ composite. The Russell 2000 is basically the smallest 2,000 companies out of the Russell 3000. So you could think of the Russell 3000 as being the 3,000 biggest companies in the United States, and then you kind of divide that up into two different portions. The Russell 1000, which will be larger companies, more equivalent to the S&P 500, and then you've got the Russell 2000, which are basically the 2,000 smallest companies within the Russell 3000. And what you have in the Russell 2000 currently is a huge allocation towards the financials, right? We've talked about this a number of times in these presentations, so forgive me for repeating myself there, but many folks will stop in, especially on a day like today where there's been a little bit more of an upheaval, and this may be the very first time they've listened to this video, so you kind of have to keep them in the loop a little bit there as well. So be aware, if you are newer, that the Russell 2000 has a big allocation towards the financials, in particular towards the banks, and in particular towards the small banks. Because remember, JP Morgan is not going to be in the Russell 2000, but many of the mid-sized regional banks that were blitzed here today, down somewhere between 5 and 10%, are part of the Russell 2000. So I think that's the reason why we have this very oddball situation right now where the NASDAQ 100 has negative correlation to the Russell 2000. Usually these indices kind of travel along together, maybe at slightly different degrees, but usually in the same direction. Right now, that's not happening. NASDAQ's going up with all those tech stocks. Russell 2000 is going down equally as violently because of all of the bank exposure that it has. So that's been kind of interesting to kind of interpret and educate ourselves with there as well. Anyway, NASDAQ was down 1.08% today. As mentioned before, the S&P 500 was down 1.16% today. The Dow Jones was down 1.08% today. And again, for those of you that have followed this video long enough, you'll know that that is fairly typical. Our assumption on a big down day is that the Russell 2000 is part of the more speculative group, so it's not surprising to see it struggle more than the market. But then the Dow Jones is full of blue chip companies that more times than not can do slightly better on a relative basis than the S&P 500, and that was the case today. Not by much, but a little bit of outperformance from the Dow here today compared to the S&P 500. But as I mentioned before, the big takeaway is, despite today's selling, we still have bullish postures on the S&P 500, the Dow Jones, and the NASDAQ composite, and to a degree that makes sense. Right, the market forecast technical indicator is not specifically designed to track what's going on with the comparison of price to the moving average. Perhaps indirectly there's a role there, but it's not a direct relationship. So there are times where you could have a bullish posture with the stock trading below the moving average. But right now they kind of confirm one another, right? We have bullish postures on those three charts, and all three of them also are still trading above their rising 30-day moving averages. That's what that green 30-day moving average is telling us. Whereas the Russell 2000, another way to identify that it's clearly our laggard right now, not only is it the only one with a strongly bearish intermediate posture, it's also the only one trading below its falling 30-day moving average there as well. The other thing I was going to quickly mention is that we almost had a bullish intermediate confirmation signal on the NASDAQ. We just narrowly missed it. Remember, in order to get that signal, we would need the green line to be bullish, which it is right now in the upper reversal zone, and the red line to be in the lower reversal zone. Right now, you can see on the NASDAQ, the lower reversal zone is at 20, and the momentum line ended today at 21.03. So I would imagine that when the NASDAQ was trading at the lows of the day, about a half an hour before the market closed, at that time there probably was a bullish intermediate confirmation signal. But because of that small bounce at the end of the day, it was able to kind of pull that red line just barely out of that lower reversal zone. So we didn't quite finish with that signal here today, but it was awfully close, and it could have existed during the middle of the trading day. And in fact, I would be willing to bet that it did exist at that time. Just didn't close there. All right, let's go ahead and now pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support us in these presentations. As many of you know, it takes a pretty big effort to do these videos. It does take at least 3 hours of David and I's day. And oftentimes more than that, believe it or not, and oftentimes cuts into, our family time and our personal time, and, we have to, record these through dinner and stuff like that. So we have to make sacrifices for you. We enjoy doing it because hopefully it's valuable to you, and hopefully it's worthwhile to you. But just a friendly reminder that we shouldn't take them for granted. And so if you want to thank us for putting the time aside to do these free videos for you on YouTube, we ask one simple request out of you, and that is to click like for us there on Twitter. That helps get our name out a little bit more, get the word out about our organization. Although we don't make money off of these YouTube videos, we do make money on our subscription business for our premium members. And so if those of you that aren't premium members could still help us by kind of getting the word out about us, or just simply clicking like or retweet, just doing the little things is useful for us. We'd really appreciate that. It's it's not really a payment per se of any monetary value, but it's a way for you to say, hey, I'm willing to take 5 seconds out of my day for you, Brandon, if you guys could keep these videos up, because I really enjoy them and I get a lot of value out of them. So, as I always say, as long as we're up and over 100 likes, I'm more than happy to do a full-length video. And the last time around, you guys did not disappoint. 110 of you stepped up to the plate. And so let's go ahead and do some shout-outs here. Let me say thank you to Irene, and thank you to Sandeep, and to John, and Surendhar, and Brandon, and Arth, and David, and Thomas, and David, and Lena, and Ron, and Dr. Bob, and Jim, and Pam, and Fun Jonesy, and Sonia, HR, Kuvia, Vernon, Roger, Jayesh, Valerie, Jeanette, Serene, Paul, Jim, Kenneth, Ash, Paul, Ray, Tim. Too many to go through all of you, but hopefully every once in a while you get to see your name in the bright lights there. And just a friendly reminder that I see your likes coming in, and I appreciate each and every one of you that take that effort from me as well. So thank you very much for that. Please keep that up. Again, I will not be doing the video this Thursday, not because I don't want to or anything like that, but because I will be out of town, probably driving across Wyoming at that time. En route to Omaha. I'll actually be taking my wife and my son with me this time around. I have an 8-year-old son, and so this will be his first time at the Berkshire Hathaway event. For those of you that don't know, his middle name is Warren, and that was not an accident. It was very intentional, so I want him to kind of soak up the experience with Dad while we have that opportunity, because with Warren being 92 and Charlie being 99, you just don't know how many more years there are for that sort of an experience. So should be an interesting one this year, as I'm playing the role of Dad along with the role of audience member in that excellent event for Berkshire this weekend. Anyway, we had a great day of classes here at Market Scholars today. I taught my dividend growth investing class where we focused on the industrial sector. We had finally a nice sell-off type of a day in the morning on a Tuesday that we could feel like we were getting some value, some bang for our buck in that dividend growth investing class. And then David taught his directional option strategies class. So make sure you're checking those out. If you haven't done so already, the recording should be available. Also, let's have a chat here about our sector selector tool. Now, a reminder, I put this together typically on Friday nights, but again, with this upcoming weekend, me being out of town, I'm not sure I'll be able to get around to it at that time, as I won't be back for classes on Monday anyway. So the reason I build this is for our Monday morning top-down trend trading class. So just be aware of that slight change in my schedule as a result of my travel plans. But anyway, this one was updated on Friday night, as it typically is here on April 28th. And is a couple of days old by now, but still was quite telling in some of the movements that we saw in it. And it was basically a reiteration of what I had shared with you the week before. Remember, the week before, we were waiting and waiting and waiting for a simple 1% pullback in the market that just seemed like it would never come. But one thing that I mentioned to you guys last week, what was interesting about it, is that we already saw on Friday before Tuesday last week, so a couple of days before that, that sectors were telling us that not all was well in the world of trading. And the reason that we talked about that was we saw technology fall from number 1 down to number 6. And I remember that was before last Tuesday's big drop in the market. So it was almost anticipatory. Usually it doesn't work that way. More times than not, it's more reactive. But in this case, it seemed like the sector rotation was giving us a clue as to how the stock market was going to trade in the near term. And so it was interesting to see last week technology fall and then having utilities rise and consumer staples rise and healthcare rise last week, right? Those are all defensive. That all happened a few days before the 1% plus pullback that we had on Tuesday. Now fast forward to this week, and it was quite similar. Again, this is not including anything that happened today. This was done late on Friday night. My apologies for getting it out pretty late. I think it was like 12:30 my time by the time I finally got this done. It wasn't mostly because of this sector selector, by the way. It was mostly because of the input that I have to put into the stock selector tool. That's really getting horsed up right now because I'm waiting for Thinkorswim to update their sectors and industries. So it's taking a lot more time for me right now as a result of them not having their materials updated. So we have to just kind of live with that for the time being. But the point is, this was done on Friday, right? It had no knowledge of what was going to happen here on a Tuesday. But it was kind of giving us the same exact information that it was the week before. In other words, look what happened here week over week. Technology fell again. In fact, I had to double check that. I was like, man, it didn't feel like technology had a terrible week last week, right? We think back to last week, we think about all those great earnings beats and all that type of stuff. And sure, some of them were in the communications area and discretionary and stuff like that. But for some reason, it kind of felt like, tech was holding in just fine last week. But the evidence suggests otherwise. Tech continued to deteriorate on a relative basis versus these other sectors out there. Now, keep in mind, this is also an equal weighted view here. So that can sometimes have an impact as far as what we think we are seeing out of the market, because most of what we see out of the market is market cap weighted, where it talks about the mega cap companies and their influence much more than the mid cap types of companies out there. So that could play a little bit of a role there as well. Nonetheless, I found it interesting that, here we go again, technology deteriorated Friday over Friday, and consumer staples went all the way to number 1. They went from number 4 the previous week up to number 1. Again, this happened on Friday in anticipation of today. That's again telling us that the defensive sectors are still holding up reasonably well at a time when some of the growth-oriented areas are struggling, especially the cyclical areas, right? The materials basically stuck at number 9. Energy stuck at number 10, and that was before today's horrible sell-off in energy, and financials were dead last, and that was before today's horrible sell-off in financials. So given what we know right now, I would venture to guess that these two will remain dead last, if I get a chance to put it together over this upcoming weekend. Now, of course, things can change if both of those, jump between now and Friday, but it is interesting that this has already been giving us a heads up as to where the market wants to go. And the market wants to go to the defensives right now, and it's very concerned about what it sees out of the more cyclical areas of the market, and that's not a good thing for the market in general. It's a good thing for me. Some of you saw my tweet over the weekend where my Roth is at all-time highs, or at least it was before today. It hit all-time highs yesterday, barely eclipsing where I was back in December. So I was happy to see that because my account was languishing in the first few months of this year as the tech stocks were taking off and my consumer staples and other boring dividend growth stocks were kind of sitting in the back seat. But they've caught up in a hurry. Those consumer staples have just ripped higher as being one of the strongest sectors here, and that's really helped support a lot of dividend growth investors. So while I personally like to see the consumer staples doing well because it means that my accounts personally are doing well, if you ask me point blank what is better for the entire market, what would you prefer? I would prefer technology to be leading this market, not consumer staples. So I don't think it's a great sign for the health of the overall market for those of you that are kind of leaning more bullishly at the moment. But things can change, and as they do, we'll help identify them for you here in these videos, assuming you guys click like for us on Twitter and we do these full-length ones, because remember, when we don't click like enough and we're below 100 likes and you guys only want me to do a 15-minute version of the video, we don't have the extra time to go into the analysis of the sector selector and factor selector and extra one-offs like that. So anyway, assuming that we will be talking about this in the future in these videos, I'll do my best to identify any major pivots or transitions that I'm seeing out there as well. All right, let's get back on track now with some 12 grid analysis over here on the Thinkorswim platform. And let's start off with chart 5A. This is our asset class 12 grid. And as you can see here, we do have a mix of green and pink charts. So they're not just all traveling in the same direction. And remember, that's typically the case with this asset class 12 grid because in some cases we have direct opposites of one another, like interest rates themselves and the bonds prices of those interest rates. So rarely will you ever see a clean sweep, but it does seem like there's more division this time even than normal. One thing that caught my eye today was how nice gold was looking, right? We've been looking at this a lot this year. There's been times where we've been disappointed in gold. There's been times we've been a little bit more enthusiastic about gold. And I would say right now is one of those times we're a little bit more enthusiastic about it. In fact, I think I still have that microcap gold junior gold mining company that trade's still on from a while back. But what caught my eye with it today was this very robust move up and off of that rising moving average. Is exactly what you want to see. Gold was up nearly 2% today, right? While the rest of the market was getting punched in the face, gold was out there, like the champ that it is, bouncing up and off of that rising 30-day moving average and retaining its strongly bullish posture, as you can see with that deeper shade of green in the background color right there. So things are looking really good for gold at the moment. It seems like they are benefiting from the chaos that we are potentially seeing there in the regional banking space. So I've said it multiple times this year that I would not be surprised if gold outperforms the stock market this year. In fact, I would not be surprised if the bond market outperforms the stock market this year. And at this point, I don't have any reason yet to change my mind on that situation. I still think that there are challenges that lie before us in the stock market, but obviously I do want to remain flexible with my thinking. So if things do change, we want to change with it. But right now, I still am impressed with gold, and it seems like it wants to make a move for all-time highs. We're not quite there, but we are in the vicinity where if you get the right type of news over the right type of week, we could be talking about gold all-time highs here. So I was really enthusiastic about that gold move here today. It's looking really strong all of a sudden. You'll notice here that part of the reason that gold was up today may have not just been solely due to the chaos in traditional financial assets, but you also saw that the US dollar was down today. That was a little bit peculiar. A lot of times you will find that the dollar will stabilize on days when the stock market is struggling, but today that was not the case. Maybe a little bit of profit taking there because the dollar had already been rallying for the previous week before that. Nonetheless, when the dollar weakens, oftentimes you do see a benefit to commodities like gold. What's interesting about it is it did not carry over towards oil. Oil was down over 5% here today. We did have some economic data that was reported. I know the JOLTS number came out and said there were a lot fewer job openings, and so that could have had an impact on how market participants are thinking about economic activity. And of course, you usually want a very strong economy in order to help support high oil prices. And maybe today's economic reports were sending the opposite message. Nonetheless, oil got hit hard here today and is clearly below the moving average now. Remember last week I was with you, I was saying, well, we'll find out soon enough where it wants to go. It's either going to break back up to the upside or break to the downside because we're sitting right on that moving average. Well, looks like we may have gotten our answer, right? It looks like it wants to break to the downside. This is one that, as I've mentioned to you guys many times over the years, I kind of call the oil trade like riding a bucking bronc. It is very difficult to stay on it for 8 seconds. It is very choppy experience. It's not a smooth experience like you'll find with other sectors of the economy. So who knows where this goes, but wherever it goes, be ready for volatility. Buckle up. You have much more aggressive movements in those areas than you traditionally have in other areas. And today was case in point. That was a really ugly candle. Whereas the stock market bounced in the final half an hour of the day, oil apparently did not. You can see here USO basically closed right near the lows of its session here today. And what a session it was, down 5.26%. Whoa, that's rough. And now we know why that portion of the heat map that we were looking at earlier looked the way that it did, with all those oil companies down aggressively. Even the $100 billion plus ones like Chevron and Exxon were down significantly today. This is the reason. Oil prices themselves got just clobbered here today. You'll notice off on the right-hand side here that the U.S. Treasury yield itself dropped here today. Again, perhaps reading into the economic reports where there was slowing economic activity, and therefore maybe the market is sensing that Jerome Powell will have less incentive to continually raise interest rates into the future if the economy can somehow cool itself down on its own. We remain to be seen whether that's actually going to happen or not, but perhaps that's what the market was trying to interpret out of today's activity. So when Treasury yields are down, remember the opposite is that bond prices go up more times than not. And that was the case with long-term U.S. Treasuries. They had a really nice day. Remember, we have an iron condor going on that right now. And that's pretty much exactly what we wanted to see. The reason I say that is because yesterday was a really difficult day for TLT. So to get all of that back and basically just go right back where we're glued to the 30-day moving average again is pretty much exactly what you want to see when you're selling iron condors and implementing a neutral strategy like we have in this very presentation with our paper money trade that we have going on it right now. So that was good news for us collectively with that trade application example there. But you still see that despite today's 2.5% move from TLT, it does still have a strongly bearish posture according to the market forecast. That's what that pink background color is telling us. And despite today's really big rally, it must have just been a couple of pennies below the falling moving average. It's hard to see with a naked eye. In fact, I could do this, right click, maximize the sell, and you can see how close that must be. It must be just like a penny or two below that moving average right now. So if TLT goes up again tomorrow, that moving average color will change. It doesn't have to change the background color because that will be determined by this green line on the market forecast down below. But there's a pretty decent chance that if we get any sort of buying at all in bonds tomorrow, we'll see that moving average color change there ever so slightly. So tomorrow, of course, with Jerome Powell speaking and what he has to say about interest rates will really drive whether that is a possibility or not. Speaking of bonds having a good day, take a look at foreign bonds. That was really nice. We're using BNDX as our proxy here, but you can see that that was a nice lift up and off of that rising moving average today, where we effectively closed at the highs. So notice that because TLT had a little bit more of an aggressive sell-off, a big up day like we saw today did not turn around the posture or the color of the moving average. whereas foreign bonds did not sell off as aggressively to begin with. So when they had their snapback rally here today, it was more than enough to change the posture back to weekly bullish, and clearly trading above the rising 30-day moving average right now as well. So between those two charts, it looks like foreign bonds is a more attractive setup right now, bullishly to the upside. You'll notice that high yield bonds did not rise today. We've talked about this a number of times over the years in this video as well. Remember that there is still a fairly large correlation between high yield bonds and what's happening with oil stocks, because a lot of oil companies had to raise capital several years ago when oil prices were terrible, and many of them were on the brink of disaster, and they had to raise high yield debt. And so a lot of the high yield bonds are still some of those oil companies. So on a day like today when oil got decimated, high yield bonds were still down despite other bond categories going up tremendously and interest rates falling tremendously. You wouldn't necessarily assume that, which is why we try to educate you with that possibility here in these videos, so you can learn a thing or two there as well, because I think most people would look at this and say, well, interest rates were down today, so bonds were up. Not necessarily. It depends on what type of bond you're talking about. But high yield bonds, aka junk bonds, struggled today. And that's not really a great sign for risk appetite either, because remember, if the market starts getting concerned about economic activity, there is a chance that TLT could start improving its prospects as interest rates fall, as there would be less need to fight inflation. So TLT could become a safe haven. At the exact same time, corporate bonds could start rolling over, because economic activity to the downside could likely mean that oil prices would be to the downside. So it's kind of interesting to see the intermarket relationships between those different asset classes there as well. Anyway, you'll notice that preferred stocks got hit pretty hard today. They were down 1.5%. They're back below their moving average with a weekly bearish posture. Remember that there are a lot of preferred stocks that are issued by financial organizations. I would say in my own mind, I don't know exactly what the percentage is, but I'm nearly positive that of all the 11 sectors out there, the sector that issues the most amount of preferred stocks is the financial sector. Many different banks and other financial organizations do that. And so this could be a little bit of a reflection there of some of the difficulties in the banking space. In fact, I think I heard on CNBC or some other business network that the preferred stocks of First Republic were not made whole. A lot of times they are, right? We usually assume that the common stock gets wiped out, right? They are, last in line, so to speak, for the company's assets whenever it goes through some sort of a bankruptcy or a receivership or what have you. But each situation is a little bit different than others as well. And in this case, I think they were saying that the preferred stocks over at First Republic were basically wiped out as well. And that usually does not happen. So maybe that kind of forced a little bit of fear into the preferred stock index here, where other banking preferred stocks, and their shareholders were sitting up at attention saying, well, wait a second, I didn't know that was possible. I better think twice about my ownership of these preferred stocks here if that's a possibility. And so maybe some of them were running for the exits here today. Who knows? You'll also see up at the top that foreign stocks sold off today. However, they did fare a little bit better than the U.S. markets. Foreign developed stocks were down 1.01%, slightly outperforming the minus 1.12% for the market itself here in the U.S. And then emerging market stocks were down 0.97%, again, slightly outperforming. So all of them were down today, but it is true that the foreign stocks slightly outperformed on a relative basis there. And you can see that all three of those stock categories up there at the top, U.S., developed foreign, and emerging foreign, all retain their strongly bullish postures, and two of those are still above their rising moving averages, with the only exception being the emerging markets are still slightly below their moving average here at the moment. I'll be curious if Berkshire Hathaway gets some questions about their ownership of BYD and how they've been selling off some of that stake here over the years. Of course, they've had that stake for well over a decade and made a mint on it as BYD has become one of the largest electric vehicle companies on planet Earth. And Buffett and Munger have been in on it from the early days, but they have been selling off some of their stake here over the past year. So they might get a few questions about that here this weekend. In addition to, I would assume, will be many questions about the banking crisis and all the regionals and things like that. In fact, Charlie was already talking about that here earlier this week, but I'm sure they'll continue with their thoughts this weekend. So it should be a pretty exciting event to hear from a couple of those 90-year-olds and all that they've seen with their wisdom and experience over the years to try to glean a little bit of insight there. Anyway, let's take a look here now at our sector 12 grid, and that will be chart 5C for those of you following along at home. And you can see even here, this is a mixed bag now as well, isn't it? Right? There was a time or two here in the last month where we had a clean sweep of bullishness, but we're no longer in that mode with a few heavier sell-off days here in the past week. And so let's talk about the ones that are now the pink charts, starting with the one up at the top, financials. They were down 2.27% today. No surprise, at least in my eyes, that they are one of those companies with that weekly bearish posture at the moment, because remember, we just saw them dead last on the sector selector here a moment ago. However, it is important to remember the sector selector, as I mentioned, is equal weighted. This XLF here is market cap weighted, so they are kind of confirming one another, even though the data points are slightly different. But it is one of our continued underperformers, and that has been the case since this big banking wipeout here that started with Silicon Valley Bank back in March. Another big loser here today that we talked about on the heat map was energy. And in fact, it was the worst performing sector here today. It was down 4.35%. Got trashed here today and easily below that falling moving average there as well. And again, remember, we already had a heads up on the sector selector when it had sent the energy sector down to second to last place 2 weeks ago, right? So this is not just because it's down today. We were already aware of this a couple of weeks ago, and this has basically just confirmed what that tool was already telling us. So it's kind of fun to see it work out that way. Obviously, it doesn't do that all the time. Nothing works 100%, but it is nice to have an additional tool like that in your toolbox. So anyway, energy got trashed here today as a result of oil prices going down significantly. They were down 4.35% today. Ouch. That is going to leave a mark. Let's see what else is in the pink. We have utilities in the pink still here as well. You'll notice that they were down 1.22% today, so they held in there okay today, but they've really been drifting lower for the last 3 weeks or so, at least on a market cap weighted basis. And then healthcare, kind of the same thing. You know, it's got that weekly bearish posture, but it doesn't look violent, right? With financials and energy, that looks really bad. With these other two down below, yeah, there's some wear and tear, a bit of selling here and there, but it doesn't look disastrous yet. It might very well develop into that, but right now they're holding up there okay, and I wouldn't get too panicky about those. The other charts are all green, but naturally some of them look a little bit better than others. As I mentioned before, the consumer staples have just been crushing it to the upside here lately. Take a look at this move since March 23rd, right? So this is a pretty recent move as well. It's really only been going on for a little over a month, but this has been basically a straight line higher to the point where consumer staples were actually losing money in February on a year-to-date basis. They were under the break-even mark. So you went from actually losing money while the stock market was up to now outperforming so aggressively that you actually have an overbought cluster signal that got put into place yesterday, which you don't see that a whole lot, but that just goes to show you how amazing that move was for the consumer staples up and off of those lows there. It does remain with a strongly bullish posture here despite a small sell-off today, and I think they did the best, actually second best here today. You'll notice that discretionary actually managed to squeak out a 0.1% gain here today. Staples were 0.27% to the downside. So those were your two outperformers today. And remember, back on the sector selector, those were the two that were number 1 and 2. And this was put together on Friday. It's not as a result of what we saw today. We already know that the staples and the discretionary stocks are where there is a little bit more strength. And so it should not be a surprise to us on a violent day like today that those two were our leadership groups. falling the least amount, or in the case of discretionary, actually managing to close up just a little bit. But it is also true that communications and technology in the upper right-hand corner also look pretty strong at the moment. Even though they sold off a little bit more today, their charts remain in a more bullish upward ascent at the moment. Real quick, I wanted to bring something up here as well regarding the, I think it's the market segments. Where did that one go? Chart 5.0. I just wanted to point something out because it caught my eye, as this is an area that I tend to hang in a little bit more with. But look at the two charts in the lower right-hand corner. I'm a dividend growth investor, right? And that means looking for companies that grow their dividends each year like clockwork for many decades, ideally. There are other types of dividend investors out there that just simply seek out the highest yields regardless of whether those dividends are growing or not. And so we have a dividend yield category that would represent them, and then of course a dividend growth category that would represent the dividend growers. And it is kind of interesting that right now there's quite the difference between those two approaches. Those that are reaching for yield right now are not having a particularly good time, as that has a weekly bearish posture and is trading below the moving average at the moment. On the other hand, those people that are looking for somewhat smaller dividend yields, but are looking for companies that are built to be able to grow their dividends through thick and thin, they're having a much better experience right now with NOBL, which tracks the Dividend Aristocrat list, up here closer to the 3-month highs than the 3-month lows, and obviously a strongly bullish posture along with being above a rising moving average in this case. So I thought that was kind of interesting there as well. Let's get into our trade application example. And I'm going to pull up chart 2A. I already told you before what we're going to be doing, which should not come as a surprise to you. As mentioned before, is if the market is down more than 1% in a day, assume that the trade idea that I bring to your attention will be a sold put on probably a dividend stock. And so that's exactly what happened here today. Let's talk about ticker symbol CCI. This is not a company that many of you are probably familiar with. For those of you that are dividend growth investors, you're probably a little bit more familiar with it because it gets a little bit more talk time as a result of a longer history of increases. This is not an aristocrat like a Pepsi or something like that. This is actually a cell phone tower company. And there was a loophole with the IRS about a decade ago that allowed those cell phone tower companies to become REITs as long as they were willing to be regulated as such and meet the other parameters in terms of paying out 90% of their net income and different things like that. But still to this day, a lot of people are still surprised, like, hey, wait a second, airwaves are real estate? According to the IRS, they can be. And so that is the case here with Crown Castle and also one of their chief competitors, American Tower. They are both REITs. And so once they converted from being a common stock into a REIT, which happened about a decade ago, so that happened here from this kind of blank white spot over here into where it starts getting colored on the chart when they started paying dividends, that's when they converted from being a common stock into an actual REIT. They have at least 8 or 9 years or whatever it is of dividend growth since then. So we're not talking about a 50-year history like Pepsi or something, but still can tell us that this company intends well and they want to raise their dividend regularly. Anyway, the reason I selected it as our sold put trade idea here this week is because I was trying to go through some dividend growth stocks, those that have raised their dividends at least 5 years in a row, and try to find the ones that had an oversold cluster signal using the market forecast technical indicator on both the weekly chart and the monthly chart. And there were very few companies that could meet that parameter. This happened to be one that did. You'll notice right here we have these little green dots showing up under this week's bar. Remember, we're looking at a 10-year weekly candle chart right now, or a weekly bar chart. And you can see that we have that little green dot showing up underneath the candle. What that is telling us is that if you were to plot this using the market forecast technical indicator, you have an oversold cluster signal at the moment. And oftentimes that can lead to some sort of a reversion to the mean type of a move. In other words, moving higher from these levels because there's been too much selling in too short of an amount of time there. So here is the weekly chart where I can show you where we have that cluster. And again, you could zoom in if you needed to see it a little bit better right there. But let me now show you if I were to change the time period of the chart to a 20-year monthly chart here. that we also have a cluster, a little green dot showing up under the monthly bar. And as far as I can tell, as I kind of just eyeball this, this is the first monthly oversold cluster that Crown Castle has had in at least 20 years. And I don't know how far back this chart will go, but I could pull up the max chart here. And I don't see another single instance of a monthly oversold cluster on Crown Castle. There's been some overbought ones with those red dots there, but I don't see another instance of an oversold monthly cluster here. So that really goes to show you how out of favor this company is right now, that you haven't seen that until this moment in time. Remember, for many years, the cell phone tower REITs were the the creme de la creme. They became some of the biggest REITs from a market cap perspective. Even now, after this immense sell-off here in Crown Castle, it's still a $50 billion company. And American Tower is even bigger than that. American Tower, for a while, was the largest REIT in the world. Again, strange because you don't really even think of airwaves as real estate. So anyway, for many, many years, people were bidding their share prices higher. We now have the opposite. Part of the reason behind that may be Elon Musk. Even one of our market scholars today was telling me that he was tuning into classes and different things like that using Starlink and out on his camping trips and different things like that. So there is fear of a legitimate business model disruption, whereas today we get a lot of our data that's flowing into our phones and iPads and all that kind of stuff through cell phone towers. There's a possibility that if launching a satellite becomes cheap enough in the future, maybe there won't be as big of a need for the cell phone towers. So I do wonder if the industry is kind of grappling with that right now, and there's a lot of negative investor sentiment that's sending these stock prices lower. So as I always warn you, just like I said a week ago when we were talking about UPS, and as I try to remind you regularly when we talk about these sold put trades, only sell puts on stocks you actually want to be the business owner of at a lower price, right? Don't take it from me. Don't take it from others around you. You as an individual have to be committed to the idea that you want to be a business owner. And some of you will look at this business and say, I don't want to be a business owner of it. And therefore, if that's the case, you should probably pass on this trade idea, right? So to each their own there. But what we do know is this company has, a good 8 or 9 years of dividend growth under its belt. And you also see that it has a very strong yield right now of 5.28%. What I ended up doing was selling the June, I believe it was the 105s. Yeah, and I got filled at 115, which was a favorable fill price because, as I mentioned, the market did bounce in the last half an hour or so. So you wouldn't be able to get 115 right now, but if it sells off a little bit more tomorrow, you might be able to at that time. But the point is, 105 is the strike that I selected, and I got filled with a credit of $1.15. So if I take that out of 105, that leaves us with an eventual cost basis, potential cost basis of 103.85, right? That's where we are now committed to take ownership of 100 shares for each contract that we've sold with this cash secured put. So to figure out what our dividend yield would be at that rate, because remember, this yield up here is telling us what's the yield based upon the current price of $118.52. What I want to know is, what is the dividend yield going to be if we're forced to take ownership of this company at 103.85? So in order to figure that out, I would take the current quarterly dividend of 1.56 cents and take that times 4 to annualize it. And then we will divide that $6.26 annual that they are expected to pay out by our break-even price of 103.85. And our yield would become 6% at that level if we were forced to take ownership of it there. So again, if you don't like the business, even 6% should not influence you or entice you to take the trade. But if you do like the business and you think that, for the most part, the world will continue to operate into the foreseeable future as it has in the past, and cell phone towers are going to be very much needed in order to, bring us all of our emails and Netflix streaming and all that kind of stuff when we're on the go, then, a 6% dividend yield combined with a company that has, a longer history of raising the dividend could very well be an appealing opportunity for some of you. Okay, so that's what I had for you here today. A little bit longer here today, but I suppose that's apropos considering I won't be doing the video for you on Thursday. So think of a little extra overtime in tonight's video to make up for my missing this upcoming Thursday, as I will be on my road trip. But I will be planned to be back on Tuesday of next week, which means that when I'm scheduled to do this video a week from today, I should be doing it. Assume I don't have any car troubles or anything like that. So anyway, not going to be with you on Thursday. David should be with you on his normal days. If you want to follow anything that I'm talking about with Warren Buffett and Berkshire Hathaway over the weekend, follow me there on Twitter. Otherwise, I will plan on seeing you all early next week. Take care, everybody. Bye-bye.